Hi everyone, hope you're all doing well out there. Today we've got a lot to talk about. We've got a lot of stories. We've got a lot of stocks to talk about. I think there's about 4 or 5 stocks on this list that I'm going to talk about today. Yeah, it's a busy one, and the crazy thing is that whenever I end up recording a video, so yesterday when I recorded yesterday's video, whenever I record the video, straight away your mind goes to, okay, what am I talking about in the next video? And last night I was kind of like, there's not really that much to talk about tomorrow, and then within a couple of hours there was like 5 different news stories, and I'm like, which one am I going to talk about? There's so much to talk about, and it's funny how it goes like that. Like, stock market is just out of nowhere, the news can change and some big story comes out, and it's sometimes quite tricky. Like, the amount of times I've recorded a video and then this happens, you're like, okay, I can't do that video now, I've got to talk about this because this is even bigger. It's sometimes you don't really see that part, but hey, it's a funny game. Anyway, I'm mumbling on, and we're not going to mumble on today. We're going to try our best not to mumble on. Patreon. If you are on Patreon, I'm going to try drop a live Q&A session tonight. So if you are on there, keep your eyes open. If you do want to see a live Q&A session, join through link in description. £5 a month. But first of all, the S&P 500. I think yesterday I made a video. This is how quickly it can change, you see. Yesterday I made a video saying like, oh, look how, the S&P has recovered. And as it just got later in the day, like it just absolutely nosedive. And we ended up with the S&P down 1.2%. And I think from the high to where we ended up closing, it was nearly another 2% swing on the S&P 500, which is a massive move once again. So yeah, that was quite surprising to see how much it kind of swung from positive to negative there. And I thought it was going to be a good day. Like, I looked at the retail sales. The retail sales were very positive. Like, people still in the US are out there spending money, and I thought, okay, that's going to give them, the market a little bit of a calm, a bit of a pause there. And yeah, it kind of like, it had the news, and it was like, yeah, that's amazing. And then eventually after that, it just kind of sold off, which has been, it's been painful yesterday. And the one stock that's really killing me at the moment is Hims and Hers. I am surprised to see how much this has kind of fallen off the cliff in the last kind of couple of weeks. Since around about $16. Well, actually, from the high in March, I think it even got up to like $17 during this time frame. Yeah, it's down like 20%, which has been a massive hit. And I think I went from about 180% up on this position. I can't remember exactly what I'm now up. I think I'm 115% on this position. And that's been a big hit for me, when that's your second largest position and it's dropped that much, especially because the power of compounding, because of how much I'm up on it now. It's definitely a big hit. And I mean, yesterday it was down 5%, and in pre-market it's down another 3%, and we're back at $13. I mean, the thing is to remember, hey, we're still up 37% year to date. And that's the key thing, is that don't get too soaked up into what's happened in the last kind of couple of weeks. Remember how we're doing in the last year to date, and overall how much we're up, up over 100% is obviously really positive. But it does seem like a trend with Hims and Hers. Like, the amount of times we see this, report earnings, it goes on a rally up, and then in the next few weeks before the next set of earnings, it then has a bit of a downtrend, and maybe it's just setting itself up ready for the next jump up in the share price after hopefully another blockbuster earnings. But it does seem to be having that trend. And somebody taught me a while ago, when I was starting to learn into stocks a long time ago now, is that eventually when you do follow a stock quite closely, you can actually start recognizing patterns that do start happening in that stock. And Hims and Hers just always seems to have this pattern where it kind of, goes up after a big jump after earnings, and then it just it ticks down just before the next set of earnings. But the big thing is to focus on the long term. I talked about this yesterday. Is even though I'm doing it now and talking about it for the last 2 weeks are down a fair bit. The big thing is to zoom out, and when you zoom out, I mean, we're coming off another mega set of earnings where the stock was up massively. You look at the projections here. Q1 revenue was hiked up to 267 million to 272 million, when the consensus was 252 million. When you start looking at the longer term picture, I tried to get this on Yahoo Finance and on the way back machine, but I couldn't really do it. But I did manage to get it on Simple Wall Street, and a lot of people do ask me about Simple Wall Street and how to join, because they see me use it a lot in the platforms, in the videos. If you join through the link in the description, you actually get a 14-day free trial. And I think at the end of the 14-day free trial, I think you get either a 30% or a 40% discount code, which is pretty impressive. And it's a great platform. I use it all the time. And I only use sponsorships with platforms that I actually use. So like Trading2 and Simple Wall Street, I use all the time. So I only recommend to you guys what I actually use myself. But anyway, what I was going to say is that you look at when you zoom out, I mean, just look at the upgrade in the revenue that keeps going up, and that's beating expectations as well, by the way. And you look at the profitability starting to ramp up. I mean, only a few months ago, people were saying like Simple Wall Street weren't going to get, Simple Wall Street, Hims and Hers were not going to get to profitability. And look at the profitability starting to ramp up. I mean, the best way I can show it is that if you look at free cash flow right now, free cash flow is forecast to come in around about 90 million. If I go on to Simple Wall Street, which was from a year ago, analysts were expecting in 2024 free cash flow of 55 million. So the free cash flow forecast in 1 year has gone from 55 million up to 90 million. That's a major increase on the forecast. And this is the big thing, is that when you look at Hims and Hers, the big thing is to zoom out and try not get caught into this short-term momentum and what's going on in the short term. It's very easy to do it, and I try to do it. And if it wasn't for doing YouTube, honestly, I would just lock it away and come back to Hims and Hers in a few years' time and just check up on it, and every couple of months, every couple of quarters, probably when the earnings come out. And as long as the financials keep moving up in the right direction, that's what you're going to get rewarded on the share in the long term. And this is it. This is it. When you look at Hims and Hers and look at the improvement of how much it's beaten by expectations, that's the key thing. So it might kill us in the short term, and the stock market might kill us in the short term. I've said for a while, I think it'd be very good for the stock market to have a break. Even with the dip that we're currently on, we're up 6% year to date, guys. That's good. I know a few people have, got used to this 2023 stock market where we absolutely boomed, and things went crazy, but we need to get back to a normal market, guys, now, and not get too stretched on the valuations. Saying that, this is the S&P 500, guys. When you look at small caps, I still think there's mega opportunities in small caps. You look at the S&P 600, still mega undervalued here. And what I'd say as well is that I was actually looking the other day, and we talk about this sell in May and go away. It's an expression used that people sell before going on holiday in May. And I've got to say, I actually remember this time last year, we had a very similar dip where we had a fantastic start and we had a bit of a sell-off during this period of time. And then a few people say, oh, that's it, that's the rally over with. And then eventually we had a great run towards the back end of the year. And I think this could be very similar. You look at, it'd be good to have a break now. We get to the back end of the year, that kind of New Year hope, kind of, Santa Claus rally starts building up. Maybe we start seeing the signs of them interest rates coming in, and then we tick up another 4 or 5% at the back end of the year. That'd be a really good year, guys. Don't get used to these years where we're up 30+% in the S&P 500. So yeah, Hims and Hers, bit of a struggle at the moment. The stock's personally killing me and killing my account as well. But yeah, don't get caught. Don't worry about it. Look at the bigger picture. Big picture is still very high from when it was the days of $3, $4, $5, $6 when a lot of us were kind of buying. And as long as financially it keeps improving in the long term, that's where we want to go. That's where we will get rewarded in later in a year's time, 2 years time, 3 years time. So yeah, that's the first thing I'm going to mention. Next thing, Dot Martens. Dot Martens came out with an update today, and yeah, wow, down 30%. And I talked about Dot Martens quite a few times on the channel, and I basically said on those videos, like, I just don't see it. I just don't see a few people were trying to bottom dip this one, and I just don't really see it. And even though it looks like a relatively low valuation, however, the profit is going to drop, so that earnings is going to increase. Obviously, it's an 8% dividend yield, but probably with the drop in profitability, they might have to lower the dividend. The big thing is that, as I always say to you guys, I always like to invest in what I know. And even though I'm not a big fashion person, I don't really go around with many big fashion items, really. I do like to keep an eye on fashion. And Dot Martens is one that I just think went through a big boom in 2018, 2019, 2020. And I feel like it's a fashion trend that just isn't there right now. And sure, it's been hurt by probably the situation, the impact in the environment at the moment. I just think it went through a very big fashion boom, and it's just not popular right now. And it will probably have its, I don't think it'll go bankrupt, and I think it will have its day in the sun again, and it will come back. But I just think its day has been at the moment, and I just haven't seen it. And the reason why I had that belief is because, like I said, I like to invest in things that I know, and I just noticed that Dot Martens shops are empty. People aren't wearing Dot Martens as much as when they did 3-4 years ago. There was a major boom 3-4 years ago. Maybe they just expanded thinking this boom was going to last forever, and maybe it's cost them. But the update, yeah, it wasn't good reading at all. Basically, the CEO's kind of walked out. If you ever wanted a sign of like, okay, this is it's gone terribly wrong. I mean, fair play for like kind of walking out there. We see so many CEOs kind of like hang on and keep getting the pay packets. But CEOs even said, I'm going to call it a day. 2024 year's results were in line with what they were expected, but the guidance, they were expecting, US wholesale revenue is anticipated to be double-digit down year on year. That's not what you want to hear after what you've already had. So, yeah, I just worry about this stock. It's just one that I just am personally not interested in. However, one that I am interested in and one that I do own is Alwave. Alwave had a bit of a whack today, down 27%. And that puts me around about break even on this position. And all the gains that I had in this position have gone like that, which is always frustrating to see when a stock has a drop like that and you are up on a position and the drop happens like that. Alwave came up with an update and yeah, I would say that just like Doc Martens, this was not a good update. It wasn't good reading. So basically, they came out that they said that the revenue is now expected to be around 318 to 323 million, with the guidance between 340 to 360 million. So they downgraded the guidance. They said this was basically because of a transition away from China and changes expected in recognition of long-term contracts in advance notes. Now, I know they're trying to be moving away from China for a while because of the risk that it potentially could have. So we've known that for a while. That's nothing surprising. Now, especially with this last part of the sentence here and the downgrade here, we only heard in January that they were basically in line with trading update. So to then do this big of a downgrade, 3 months later, is quite a surprise. And I basically think that the downgrade here isn't because of a transition away from China, because obviously if you were going to impact your revenue that much, you would slow the transition down. You wouldn't do that to your shareholders. What I think has happened is that auditors are basically gone, yeah, you're accounting for this amount of revenue this year, but you can't do it this year. You're recognising this revenue wrong. So I actually think the auditors here have kind of come in and gone, no, you can't do that. Which is a little bit disappointing, because the thing with Alwave is that the reason why Alwave is down here is because basically they didn't build the trust up with Wall Street and investors, and that's what ended up getting the share price basically killed from the IPO to where it is right now. So the fact that this has kind of happened again isn't really positive from an investor point of view, because we want them to build up trust, we want them to kind of be in line with expectations. So this isn't good planning from Alwave and the Alwave team. A bit disappointing. Now, it also was a bit disappointing because the EBITDA was also going to be lower, so we're going to hit the bottom line hit as well. And also, from a year-to-date trading update, they said the company has seen stronger than expected start to 2024, which I was like, okay, that's probably more important, that 2024 guidance has started off really strong. But then I actually saw the actual guidance that they gave, which was for the revenue to be between 135 to 165 million. And approximately adjusted EBITDA of 70 million to approximately 20% revenue, which I was very disappointed with, because I looked at the guidance there and that was a good, I would say 10% below the numbers that I had written down for Alwave. So I was a bit like, hold on, you're saying that you've had a positive start to 2024, but yet from what I was expecting, you've downgraded on my guidance. And I think for Wall Street as well, I think that the guidance here was a little bit lower than what was expected. And I was a little bit disappointed. Kind of like, I think there's more going on here, but I don't know what it is. It seems like they're not being a little bit honest about what's going on, because they're making it sound like there's not much of an issue here. But from what I was expecting, it seems like a bit of a downgrade. And once again, they kind of blame this kind of China situation. I was like, I don't know if it is a China situation. I don't know if you're being honest here. So I looked at the drop today, and originally I was like, oh, 27%, that seems steep. And then I looked into the update that Alwave gave us, and I was like, I can see why the market didn't like it. Like, the revenue was a little bit disappointing there. And then what was surprising is the profitability and the revenue for the next year. I was like, that was a bit of a drop. So I looked at it here, and obviously it's all kind of priced in now. Maybe there's a bit of sandbagging going on here. But the big thing is like the trust, and that was always the issue with Alwave, is the trust from the management team. And I was hoping they weren't going to do any of these sort of things anymore. And I was looking at that going, this has always been my big issue with Alwave. And I looked at that update and I was like, I can see why the market's not happy with it. So I'm going to have a think on Alwave in the next kind of couple of days here, because that was my biggest concern. And the fact that they're living up to that biggest concern makes me a little bit worried here. So yeah, I'm going to have a think on Alwave on the next kind of couple of days. Wise. So Wise is another UK technology company that We don't have many of them. They're down 7% today, which is a fair bit of a drop. But year to date, basically flat now. But it's had a cracking last year, up 45%. And I looked at their update and I thought the numbers actually look okay. I don't know if the valuation is just kind of catching up to them. 41 times earnings. It seems like they were, when I look at the media outlet, I don't know it that well. So if you know Wise that well, please don't shout at me in the comment section, because I'm coming it from I've never really fully looked into it, and there's probably people watching this video that know it very well. So I've never properly looked into it, but they said that revenue misses expectations. But I thought, anyway, these numbers are pretty impressive anyway, so I don't know why they're getting so upset about it. But I had a quick look on Super Wall Street, and what really surprised me is like the revenue growth is really starting to slow down here, and I was like, I thought they were expanding into new markets. So I wonder what's going on with these the revenue forecast here, because at 40 times earnings, I thought if they're growing 20+% a year, that's really good. But if they're growing 10% a year, that's a little bit disappointing. And then what surprised me as well is the profitability side of it. The profit as well is very flat as well. So I was like, that's a little bit worrying there. And financial health wise, they've just took a load of debt on. I mean, they had a clean balance sheet, which we like clean balance sheets, and out of nowhere they've stuck 293 million of debt on, which puts them up to nearly 4% debt to equity. So I was looking at Wise going, oh, this could be a little bit of opportunity here. Market overreacted to decent earnings, and then I went to look at the forecast and I was like, oh, the growth's slowing, the profitability is slowing, and then they took a lot of debt on. So at first I was like, I might have a little bit of a look into this one, and then I was like, I don't know what's going on there. So I don't know the company that well, and people might shout at me in the comment section, but the reason why is because of this and this and this. But I was going to have a bit of a look at this, and then that kind of took me back. I don't know, any of you guys interested in that one, let me know. Is it worth a look into that one? That was just kind of a couple of things that I noticed. 217 came out with an update. I said that it would go up on the update, knowing that I sold it, but it didn't. It went down on the update. And yeah, I could see why. There was a lot of unclarity. I mean, we're in 4 UK companies here. Look at the unclarity here with a lot of guidances. Shows that it's really hard to forecast, with people kind of forecasting, are we going to get the ramp up this year? Are we going to get the interest rate cuts? Is inflation going to stay sticky? Does that mean the interest rates are going to stay high? There's so much uncertainty around so many management teams when you look at a lot of these guidances out here. But they came out with I straight away went to the outlook. I went, what are they guiding for? Talked about the games, talked about the challenging market, but I was looking at, talk to me about numbers. And when I got down to the bottom of it, I finally got there. So we remain confident that the group can deliver an improved underlying trading performance in financial year 2024. So with improved, I don't know if that means the aspects of revenue or profitability. I would hope it moves a little bit in the right direction, because they took a lot of cost-cutting measures in here. In line with current market expectations. So if the market expectations are right, it should be okay. But what I was quite surprised is that we remain positioned for continued growth over the mid to long term, but not in the short term. So I was thinking, okay, you're in line with the market expectations, but then you are continued growth over the mid to long term. So why not saying, in the short term as well? Why was there no percentages put in here? I thought the guidance was very vague, and I think maybe that's why the market kind of threw the toys out the pram a little bit. Because I was looking at the numbers here, and if you look at analyst expectations, by the end of the year, they're expecting the profitability to go up to 23 million. That would put them on about the level of where they were at in 2022. So I was like, can they recover that much? And maybe the vague guidance there. I mean, obviously they put trading in line with expectations, but I thought that's a big, upgrade there. And there was no kind of pinpoint numbers in that guidance that's where they're going to go to. On a revenue point of view as well, they're expecting a bit of a rebound in revenue, and I thought, is that going to happen as well? So we'll see what happens there. I think the vague numbers there maybe put Team 17 off. The other thing that put me off with Team 17 as well is that I never mentioned is that they're forecasting a big rebound here with some of the games that are coming up. But at the end of the day, what's the biggest game that's going to be coming up in the next kind of couple of months or year? You've got GTA coming out. GTA is going to be massive, and is that going to take all the gaming space over there, and anyone a bit smaller are going to suffer because of this big launch with the new GTA coming out? And is Team 17 going to be one of those that suffers? We'll see. So that was also something that was running in the back of my mind. And the last one, we're finally on the last stock. This is a long video. I hope I'm not waffling on. So the last one, Tesla, down 5.5% yesterday, joining with the market dip, obviously as well underperforming the market as well. Pre-market down another 2% as well, not looking good in pre-market, and we have seen Tesla hit the $150 mark, which is always where I said that potentially I would look then buying Tesla. Now the problem with Tesla is that it's got worse than what I expected. So from where I was at the start of the year to what the numbers I now expect them to do, I don't know if I want to buy it $150. I don't know if I want it a little bit lower than where it is right now. Now, obviously, the reason why is they're going to cut 10% on the global workforce. I don't know if you saw the message from Elon Musk. He was trying to spin it in this positive light, and he was like, nope, it's not positive, Elon. You're really good at protecting the share price, but the reason why you are cutting the workforce is because you have to cost cut because you're not expecting the demand that you were expecting. That 50% growth you expected every year, it's not happening. That's why you're cutting the workforce. Now, obviously, this isn't good because this kind of says to investors that this isn't a short-term issue. The fact that you're cutting this much is that it's probably something that's going to probably maintain for the rest of the year. And what you're going to have is also a bad year for Tesla in 2023 and a bad year for Tesla in 2024. And the big thing is this is supposed to be a growth stock. You can't be a growth stock if you're not growing. In fact, you're declining. Your profitability's declined massively in the last few years. So you're not a growth stock at all. That's where the suffering has kind of come from. And so this is a bit worrying because it looks like the pain's going to continue. And just kind of put it into context why I struggle with Tesla a little bit at the moment, because I thought 150 I'd be buying. But now I'm even a little bit, at the moment I'm still hovering a bit like, do I buy or do I wait for it a bit lower? And the reason why is because if you go, look at Yahoo Finance, by the way, look, they've upgraded the website. How fancy is this? But if I use Wayback Machine and I go back to the January the 26th, 2024, so I'm only going, 3 months ago, start of the year. And if you look at the start of the year, revenue was expected to grow 19% this year. And that's what I was expecting. I didn't think they were going to grow this much, but I was expecting plus 10% growth. Analysts are now forecasting this year to grow at 7%. Now, if you look at the last quarter, or this next quarter, it's 2% growth. So they're expecting even a ramp up in the back end of the year, which we're only going to get if interest rates come. So that's a little bit risky. So that's going to be 7%. That's a massive downgrade from only 3 months ago. And when you look at where it was 3 months ago, we were talking about a stock that's $182. Since then, the stock's only fallen to $161. We're only seeing about a 10% drop on the share price, even though the revenue has fallen that much on the guidance. Now, that's not the worst part. The worst part is from a profitability point of view, we're expecting $3.66. And that was from a year ago of $3.12. So we're expecting EPS to move in the right direction. Looking at EPS and the P ratio, okay, the P ratio is going to drop. It's going to look even cheaper. That's quite nice. Now, if you look at current forecast, the current forecast is for the EPS to be $2.71. $2.71. We've gone from 3 months ago, an EPS forecast of $3.66 down to $2.71. That's massive. That's a 30% drop in the EPS guide. And then I look at the share price, and I'm looking at the share price that's, it's dropped, but it's dropped 10% of an EPS downgrade of 30%. Like, surely we should be looking at Tesla realistically now down more than that. Surely Tesla should be more towards the $120, $130 range, and that's where I start looking at, is that where I consider buying? I can't believe the stock's only down 10% after the EPS has been downgraded 30% in 3 months. That's absolutely bonkers to me. So this is the thing with Tesla, is that if Tesla was doing these numbers that I was expecting from January, obviously my numbers were a little bit worse than what analysts were expecting, as you guys saw, I'd probably really consider picking up Tesla at 150. My problem is now that the numbers have downgraded that much that I don't know if I can buy at these levels, which is the really tricky thing. And sure, Tesla will rebound when interest rates start improving, but the problem is now that I'm looking at a bad 2023, a bad 2024. I don't know what numbers Tesla are going to do in this longer term. When everything stabilizes, what are Tesla going to do when interest rates are cut? What are they going to do in 2025? What are they going to do in 2026, 2027? I don't know. This is supposed to be a growth stock. It's priced at a growth stock. It's 37 times earnings, guys. For a company like this, you'd be hoping for not even 10% growth. You're probably expecting, a good 15, 20% growth. And are they going to do that? I don't know. Obviously some of the Tesla bulls will be typing in the keyboard and smashing it already, going, you don't know what you're on about, as they always do. But, I've been right on Tesla for pretty much the last kind of 6-7 years, and I'd kind of back myself to kind of call this correctly, and I'm not sure on it anyway. So, yeah, I'm having a think on it, but the problem is that it's deteriorating a lot faster than what I was thinking anyway. So, anyway, those are the updates today, guys. Obviously, remember the long term. Long term's the main thing. Don't panic. Hims and hers suffering in the short term. I'm suffering in the short term. Keep looking at the long term. Doc Martens, Yeah, looking painful. Not interested in it though. Alwave, pretty bad update from them guys. I'm going to have a think on them guys in the coming few days. And we've also got Wise. Don't know if that one's worth looking into. And I think the last one was Tesla. And yeah, I'm definitely a little bit concerned around Tesla at the moment anyway. So that's the video for today, guys. A bit of a long one. Hopefully I've not waffled and mumbled on too long for you guys. And yeah, any of you guys that are on Patreon, I'll probably see you in a couple of hours, hopefully, if I do this live Q&A session before I go to the City and Real Madrid game tomorrow. That's why I can't do it on Wednesday. I'm doing it. So that's why I'm trying to do it tonight, so I can... it's probably the only night I've got free anyway. Anyway, mumbling. End of the video. Have a good day. See you in a bit.